Would you agree with Mark Andreessen, a parade of horrors?
I think that's a little extreme, but he definitely has a point that our firm would agree with, which is it's difficult to take companies public today. And a lot of the fast-going companies, the CEOs, the boards actually don't want to list. They want to keep their companies private longer. And that's just a general trend that's happening in the marketplace.
Now, because you invest mostly in secondaries, isn't the more companies are scared of going public, isn't that better for you?
Sometimes. I mean, the secondary market needs liquidity ourselves. So it just depends.
So it's always finding a balance, right? Not waiting too long, but not going out too early, right?
That's right. Yeah, there's a little bit of timing in our market when you buy shares in companies or limited partnerships in funds where you're trying to predict at what point you'll get your own liquidity event. But there's definitely elongation of the top hot companies in the venture market staying private longer, growing larger, and using the secondary market for liquidity for their stock.
Now, I just want to put into context, what you do. Again, you're invested. You have small stakes in a lot of companies, 100 different companies or so, and the vast majority of those are secondary shares, right?
That's true. Mm-hmm.
So, post Facebook IPO, what sort of movement or trends have you seen in the secondary markets? Now that Zynga has flopped, Groupon has flopped, a lot of investors who bought shares on the secondary markets are underwater. Is that scaring investors away now?
Some have been scared away, but there's about 30 to 40 active buyers of secondary shares that have dedicated pools of capital to buy in the market, and most of them are still buying. They've shifted their buying into software companies, SaaS companies, away from consumer internet companies over the last year or so because of that reason. But the general market's extremely healthy. We think that there's been a structural change in the venture market over the last 5 years, and Facebook was one of the first instances of that where a company would stay private longer and then wait to go public until they feel like they've got their base business at a scale that the public markets will accept and have a successful offering.
So other than you, who are these people that are buying secondary shares? I mean, would you say that, before Facebook, there were some people who were doing this who weren't necessarily as experienced as you are? Or, do all of these guys know what they're doing?
There's a portion of the buyers that are extremely experienced, and there's a portion of the buyers that are not experienced, just like any market. But there are definitely a lot of sophisticated buyers in our market that do a really good job of doing their analysis and doing the bottoms-up company valuation. Now,
Facebook is really the last big consumer tech company to go public, so we haven't seen one in almost a year now. When is that going to change? It doesn't seem like Twitter, which is often mentioned, or Airbnb, that any of these companies are really close.
I think you'll see in the next year or two some large consumer internet offerings.
Like what?
We'll see what Alibaba decides to do and what Twitter decides to do. It's really at their own option, right, as a company and as a board to decide if they want to keep their businesses private or go public. And those are two names that are batted around the venture business.
And you are an investor in. I know you're in Alibaba. Are you in Twitter as well?
We're in both.
So what does this mean for you?
It would be a good thing because then we would be able to get some liquidity on our own funds and then keep the market more liquid on the private side. All the funds that manage secondary funds need to get liquidity as well to keep investing their cash in the market. And we're in a period of the market where it's sunny out. It's a good time, and there's a lot of cash coming in and out of the market. And the primary venture market is pretty healthy. It was down year over year last year, about 10%, but generally it's pretty healthy and it's starting to generate some nice returns.
Now, Alibaba just bought an 18% stake in Sina Weibo, which is China's version of Twitter. So now you're invested in Twitter and China's version of Twitter. I mean, from a strategy perspective for Alibaba, what do you think this means?
Well, the Chinese market and the Asian market's very different than the U.S. market and the European market. And Alibaba is the dominant player over there in e-commerce. It's basically like if you're in the U.S., it's like taking Amazon, eBay, PayPal, Craigslist, and all of those and wrapping into one business that has a dominant, very dominant share of all those markets. And so, they've done a very good job of being the alligator in the river, as he likes to describe it.
And just a last question. Since Facebook and this year, what are you doing differently than you were before? Are you investing less in consumer and more in software services? Where are you going to be putting your money over the next year as, some of these consumer technology trends have really matured?
Well, our firm's got into other segments of the market over the last 3 years. We've bought into some healthcare investments, biotech, med tech. We've also bought into a lot of software companies. About 60-70% of all our money in the last 3 years has gone into the software market. So it's security software companies, application as a service companies, various types like Vitru. And I talked to you about Vitru last time I was here.
Right.
We've done a lot investing in those sectors. Clean tech starting to come online because there's been a nice flush out of the market there, and some of the leaders are actually starting to do well.
Because that hasn't happened. I mean, everyone's been sort of waiting for clean tech to
this year I think
have its moment.
This year I think it's bottomed. I think it's gotten to a good point where the successful businesses in clean tech are becoming successful, and it'll take another year or 2 years for the general market to see that. Right now you're seeing press around Fisker going under, and there's a lot of negative press. But when you look under the covers, the market's quite healthy with a few subset of names.